Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Welcome back. You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, last week you put a long position on Telkom, the mystery that is Telkom, because it's been an unbelievable performer. Lots of us not quite sure why it's rallied so much, but there was a bit of a downturn, and you'd gone long of the stock. Has it worked out how you had intended it to?
Yeah, it's worked out exactly how we intended it to, actually. So it's been a good story. We've taken profits on the trade. But if I quickly take you back and let's have a look at why we did this trade and what initially attracted us to it in the first place. What I've got on the screen at the moment is a daily chart of Telkom. And what you can see is that over a period of about 4 days, we saw the share price dropping 20% and on pretty large volume as well. And that always obviously tweaks interest. And the reason I believe for that was that there was a downgrade of the stock by one of the big international brokers, and that saw the share price coming under some pressure. But what was interesting was that it fell very sharply into that support zone that I've identified over there. And that support zone is really at around about 70 Rand and down to about 66 Rand per share. It fell very hard into that support zone, and then it sort of stabilized. And we always, I look at what I term a 3-day rule when it comes to shock news events. And in some cases, it's a 4-day rule, kind of like what we saw here. But the bottom line is that you see 3 or 4 days of very, very heavy selling following some sort of shock news. But then typically that results in an overreaction. And then invariably you do then see like a reflex bounce in the share price thereafter. These heavy sell-offs are often combined with very large volume, which we'll show you on the next slide. And what that really implies is that you've had a mass amount of selling on the one hand from what I deem to be rather panicky sellers. And then on the other hand, you've got buyers, obviously, who see an opportunity to buy the stock, to pick it up at a bargain, and who see an opportunity. And typically what happens is that once the sellers have finished selling, they've got no more shares left to sell. They've literally exhausted themselves. Those shares are now in the hands of new shareholders who've taken up the stock at a much better price. They are far less likely to panic sell the share. And once that dust settles, what typically happens is that there's a bit of a vacuum of selling pressure left behind, and that then results in the share price bouncing. And this is a trade strategy that we've employed successfully on quite a few occasions on the show. And this is yet another example of how it's worked out. And if we actually zoom in now and we look at an hourly graph of Telkom to illustrate this point more clearly, you can see how we did the trade. So this is an hourly graph. This is literally a screenshot taken off of my IG Markets trading platform where we trade our CFDs. And as a client of IG, you'd be able to get this exact chart up yourself. Now, what you can see there is that we had the very aggressive sell-off, but then we also had a reversal. And we had that reversal kind of came about with elevated volume. The volume spike there illustrates 1 hour worth of volume. But if you look at the volume candle surrounding that one volume candle, actually we saw about 3 days worth of fairly heavy volume selling. We then saw that reversal, and I took that as the opportunity to then buy some CFDs in Telkom. And we bought 1,475 CFDs at 70 Rand. I set a stop loss at 68 Rand, which would have implied that the share price would have needed to have then taken out the lowest point of when that selling had reached fever pitch. Yeah. And then what you typically do with these types of strategies is you look for a 5 to 10% bounce, and it usually comes within a couple of days. And that's exactly what we got here. So I sold out at 75 Rand. That was our target for this trade. It's gone higher than that. I mean, I see today it's trading up north of 77. That's fine. We leave some money on the table. It doesn't matter. You're never going to get the exact top and bottom. We had a strategy in place here. Our strategy was to sell it at 75 Rand. We've done that, and we've banked a nice, healthy profit, almost 7,000 Rand, when we've taken cost into consideration. So not bad. When you consider that we risked just short of 3,000 Rand on this trade, we've come out with a close to 7,000 Rand profit. It's a very nice, successful trade.
And opportunistic, I think, is the word that I used last week, and I use it again because, as you said, it wasn't for a huge amount that you were looking to bank on this. and nice to actually sell out at your level. So you don't feel any regret that it's traded higher.
No, I don't. I think this is also the type of trade where you just kind of keep the scoreboard ticking over. We're all into the cricket at the moment, and you know that I love to draw parallels between trading and cricket.
Is this a 1 or a 2?
This is a 1. This is a single. This is where
Single.
you just take a single and bank a small profit, but it keeps the scoreboard ticking over. We didn't take a big risk on this trade. It certainly wasn't one we were going to try and hit out the park for a 6. This is just a small bread and butter kind of trade to keep the scoreboard ticking over, and we've made it tick over, and it keeps us in the game. And we'll look for the big opportunities to try and take a bigger risk, but not on a trade like this.
Okay, cool. Garth, moving on to yet another dreaded option structure. So we've had one in place for this, since the beginning of the year, essentially. Futures closeout is when? Next week?
It's this week, Thursday.
This week, actually,
yeah.
yes. It's unlikely to pay off because the market has actually been quite strong, but you're setting another one in place to hedge us against any pullback in the second quarter. So perhaps you want to kick off with what your intention is.
Yes. Well, regular viewers will know that we do these structures every quarter pretty much. And I put them in place purely because I like to have a bit of downside protection in the event that the market does pull back.
Yeah.
If it doesn't, the protection that we buy ourselves here is actually very, very cheap. So the one that we've done for the March futures closeout, you're quite right, it's going to expire worthless in all likelihood, but that's fine. I think it cost us less than 3,000 Rand or thereabouts for the protection in the March structure. We lose that, it's fine, goodbye. We don't cry about that. If the market had have pulled back, that structure would have worked out nicely for us. Now I'm doing one for the June futures quarter. So in other words, this effectively gives us exposure now for the second quarter of the year.
Yes.
And again, if you look at that chart of the top 40, you can see that we've had a very, very powerful run through January and into February on our top 40. And we've actually run into some resistance there, overhead resistance at 47,200. And if you look at that chart, which goes back over a year, you can actually see that our market has pretty much been range bound between 41,500 and 47,200 for the last year. Now, obviously, that's a very broad range. It's an extremely broad range. But we've hit up against the top of it. It does look as if the market has sort of run out of a little bit of momentum here for the time being. And I guess the question is, do we just consolidate sideways from here, or do we see a slightly deeper pullback during the second quarter? And I don't know the answer to that question. But what I would like is to try and create some sort of protection for us in the event that the market falls back towards the middle of that trading range. And I'm looking particularly for cheap protection here. So I want to be exposed to downside protection, but I don't want to pay too much for it. And I've managed to do that very effectively with an option structure, which I'll now take you through step by step.
Just before we get to that, people will say, well, why don't you just short the market? But that can be a very, very expensive way of trying to get yourself some gains or advantages from the market falling back, because if it doesn't, then you've got a problem on your hands.
Well, that's right. I think going what I would term naked short obviously exposes you to risk. If the market were to continue moving higher, then of course you lose money on your short. The higher the market goes, the more you lose on a short. Doing it this way, as I'll show you now with options, you actually limit your risk. If the market were to continue rallying, it can go all the way to the moon. It doesn't matter. It's not going to cost us very much. But in the event that the market does come down, it gives us participation. And I like doing my shorts like this because it limits my risk, it defines my risk,
yes.
and I don't have the open-ended risk of a naked short position, as it were. So if we have a look, now what this graph is if you look along the bottom axis there, those are the levels on the top 40 index. On the left, I've got profit and loss, obviously profit above the line and loss below the line. Now, in order to effect the structure that I've done here, there are three legs to this trade. It's not a traditional put spread as we've done in previous quarters. This one's a little bit more complex and actually better, I think, than many of the structures we've done in the past. First of all, I've gone long of two contracts of the June 2015 Aussie 46,500 strike put. So what that means essentially is that above 46,000, I've paid away premium. I've paid 13,529 Rand for each of these contracts, and I've done two of them. So it means I've actually paid away 27,000 Rand in premium. Now, obviously, below 46,000, that put option will start to make money, and it will make money all the way down to naught if the market goes to zero. But let's face it, the market's not going to zero. Nobody's as bearish as that. So we've got to be realistic about where we think the market could go in the event of a pullback. And then what I like to do is sell away some of that downside participation so that I don't have to outlay that full premium of 27,000 Rand. So what I've done to effectively earn myself a bit of premium, I've sold short some out-the-money put options. So first of all, I've sold short 2 options with a strike of 44,500, and I've received 7,457 Rand for each of those options, which means with the 2 together, I've earned close to 15,000 Rand in premium on those 2 options. That's what I've been paid. Okay. All right, but now you can see below 44,500, that put option would start to lose money. Against that, I've also shorted another put option. I've shorted 2 of them, this time with a strike of 43,000. And for those, I've received premium of 4,822 Rand each. So the 2 together earn me 9,644 Rand.
Okay, the obvious question is why have 2 different levels at which you've sold these put options? Well,
what you'll see now, if I show you the whole payoff profile of the structure together, it looks like that. That yellow line that I've introduced onto the graph there is now the payoff structure of the whole structure once those 3 options are overlaid against one another. Let's just tidy it up quickly, and you can see that's how it looks. And essentially, what it means is that above 46,500, I lose a premium of 2,500 Rand. That's gone. I write that off and I say that's my insurance premium. Happy to pay it. My profitable area is between 46,500 and all the way down to about 41,000. That's a correction of anywhere between 1% and about 13% correction in the overall market. My sweet spot is between 43,000 and 44,500. In that area, I would make my maximum profit, which is 37,500 Rand. So you can see that by doing it this way and by selling 2 different staggered strike levels, out the money put options, I've effectively broadened that profitable area for myself. And this kind of alleviates some of that tail risk, I call it tail risk, where if the market were to really get a big hiding, you go into that danger zone, which is the red little triangle on the left of that graph. That tail risk area is so far away, I think it's highly unlikely that we're going to go there. But there's probably a fair chance that we could go into the middle of that structure somewhere, and then we would earn a profit on that.
Okay. And we said deep out of the money put options. That was the second leg of the selling short of those puts.
Yeah, the 43,000 strike puts that I sold, those are very deep out the money. Those are approximately 10% out the money at the moment.
And that must make it quite cheap, or you probably get quite a good...
Well, remember, I've sold those short, so I receive premium on those options.
Okay.
But yes, they are cheap, but you still earn a decent enough premium. I like to try and get these put option structures to be close to self-funding. And with this one, it is close. You can see I'm paying away 2,500 Rand, which is small in our universe of what we've got available to us here. It's less than 1% of our capital, effectively.
So if you had to sort of plot that against a graph, say, of the all share.
Yeah, all right. Well, here's the top 40 again, what we looked at previously. And obviously, I identified that that's the zone, 41,500 to 47,200. Now, if I overlay that put option structure that we've just described, there you can see it. So very, very nicely illustrated. The June futures closeout is right there where that white line is going down the middle of the page effectively. And you can see between 46,500 and all the way down to 41,100, that's where we would make money on this option structure.
Okay, guys, so slightly more complicated, but not just an extra leg, essentially.
Just an extra leg, and the thing is that selling that extra leg deep out the money actually affords us a far broader profitable area than what we might have otherwise achieved on the previous structures that we've done.
Yeah, and I'm sure viewers, if they were watching the show last year when there was that big slide in the market, they would have known just how worrying it was at that point. Yeah. Okay, guys, so that's in place. You've taken your profits on Telkom. So what does the portfolio actually look like then?
It looks like this. So we're sitting with 298,000 Rand in our account. We actually went over 300,000 Rand this week, but now because of the 2,500 Rand premium that I've paid and accounted for on this option structure now, we dip back underneath 300,000. Anyway, we're up 19% for the year to date, which is still pretty good. Those are all the trades that we have open or have closed this week. So we've still got our pairs trade open with Pioneer Food and Zeda. Yeah. We'll readdress that at some point. At the moment, it's not doing much for us. At the top top of that page, we've got the March put option structure, which is going to expire worthless. We lost 3,200 Rand in premium there. That's gone. Telkom, we've taken a nice profit today. And then, of course, we've gone and discussed today this June 2015 option structure now.
For 2,500, which is actually a little bit cheaper than what you paid for the March one.
Yeah.
Okay, guys. And if anyone's got any, I suppose, confusion about it, they can watch the video of this on your site.
Yeah, they can watch this video on the Business Day TV website or on mine, traderscorner.co.za, and also on my website. I've actually detailed the whole structure and how the payoff works and everything.
Okay, great. Garth, we have to leave it there. Thanks as always for joining us on the show. That's Garth McKenzie, founder and editor of Traders Corner.
Traders Corner is proudly brought to you by IG, the specialists in CFD trading.